Okay, that you heard. Hey, all right, let's
That I
go.
heard.
And this one, Zoran Zokolovsky. Was that
I
good for
hear
you?
that. I hear that.
All right, good. Zoki, welcome to the show. It's great to have you back. And
Thank you.
we
Thank you,
haven't
Nick.
spoken. Thank you. We haven't spoken since last year. We had a little bit of an audio issue with our last show, and you were really the reason, Zoran, that we went and spent a small fortune on this on this new audio software of ours and hardware with the Rodecaster Pro, the Pro mics, and really because the reason I did that is the information that you were sharing was really valuable, and we didn't
Mm.
want people not to be able to hear it. So we're going out live now on YouTube, and I wanted to chat to you about 2025 New Year. And you've also got a couple of products that you've been looking at and examining as well that you'd like people to have a look at. So let's start out firstly. Welcome back. And how was
Thank you.
your December? How was your New Year? How was the break?
It was busy, actually, quite busy. And also, at the same time, I spent some time with my family, which was always the best thing to do in December.
Always.
Uh, uh, re- Funny enough, I actually reviewed my retirement planning. I actually did some changes to it in January, so it's right about middle of January. So yeah, um, and yeah.
Okay, fantastic. Now, for New Year, you've been in this industry for how long? Pretty much nearly 3 decades, right?
Ooh, that sounds a lot. It's fine. 23, 24 maybe now. Yeah.
Yeah, 24 years. Okay, so close, nearly 3 decades. I like to scare you, make you feel older.
Thanks.
A lot, a lot of people are coming into the new year with financial resolutions, New Year's resolutions. They want to get into shape. They want to lose weight. They want to become more
Mhm.
financially responsible. All of these things, and there seems to be a good energy at this time of year in South Africa. Most people's tax year, right, is coming up at the end of February. You've got to get everything submitted. You've got to get extra funds into your retirement planning, and you need to start looking at what you're wanting to do, where you're wanting to go. And sometimes, if we look at where the stability of the country is, a lot of people are going, okay, I need to put extra money into my retirement savings because of what I'm going to get back in the tax. But is that really the best use of my money? Is it the safest use of my money? Do I want to be tying myself financially to South Africa? So, looking at this new time of year, the new resolutions, things that people are wanting to do and to start and to connect with. What should what should people be doing to look at their finances now? And I know you will always say, it's any time is a good time, but beginning of
Yeah.
the year, what should people be looking at?
So as you said, any time is a good time. I mean, anytime you have a chance to actually speak to somebody or get some kind of epiphany about your financial situation. These are usually things that happen to us. When something happens and then we realize, oh, wait a minute, I need to think about this too. It's a great time, but obviously, the New Year is something that's like a tradition in South Africa to do that. And of course, I mean, there are a lot of things that one should do. Um, I mean, recheck their will. I will say that's one of the very important things. If they never do that during the year, then the beginning of the year is actually the best time to check is the will set up and is everything in order, beneficiaries, executors, and everything else.
So, just on
But
that point, if I can
yeah,
interrupt you, a will, basically what you do is you work with high net worth individuals, sort of medium net worth individuals. So I don't want to limit what you do,
yeah.
to build an international portfolio, to build a portfolio of investment and risk internationally. What happens if I don't want to have my will in South Africa? Is that an option?
Only if you cease to be a tax resident and residents of South Africa.
Right. So what
As
are some?
long as you are
Sorry,
in
Zaki.
any, as long as you're in any form, the tax residents or residents of South Africa, you will be taxed on your worldwide income, which means you can have a will somewhere overseas, but you need to have a will for the whole of all of your assets overseas in South Africa, because it will be subject to. And this is another step I wanted to say. While they're checking the will, they should check the assets and liabilities and
Mhm.
see if they have enough liquidity. Because increase of state duty from 20 to 25%, and then after a certain amount it goes to 30%. There's capital gains. There's a lot of things that you actually don't think about, but they can cripple your family's future if something happens to you.
Right.
So, you can't just leave the beneficiaries and think everything is fine. I have my executor, I have beneficiaries, but if you don't have a liquidity, then it's a problem. And yes, if you do have the house in UK, or you have investments in Switzerland or anything like that, um, it will be counted into the estate of. I mean, it will be taken into account when your estate has been handled by the executor. And it has to be given to him. Even if your executor doesn't want to give him, I mean, the financial institutions across the world are very connected now.
Right.
So, are you there?
Yeah, I'm here. I'm here. I'm listening. I want you
Listen,
to. I want you
I'm
to give me
saying
the
that,
full screen. So,
yeah, I'm saying that financial institutions are so connected now. They send the information to
right.
each other by various laws, So I would say that's one of the big things that you should look at, and obviously get the proper advice if you think that something might be off there, or if you need somebody to calculate it or to help you how to actually tackle that problem of liquidity, for the taxes and for everything else. The next thing is, obviously, people are looking at medical aids. This is they usually do it in December, but I know they're busy in December, so that's another thing that's very important to have a look, because annually they change a lot of things. They change like co-payments and all these things, all these nasty little things that they add sometimes, and you're not aware. So this is a perfect time to actually look at your latest policy from the medical aid, what's changed for 2025, and to compare it to last change to see that you don't have a problem. If something happens to you, you go on a holiday. Um, and then, yeah, we are now in February already. So this is a big thing in South Africa. People are saying invest money, as much money as you can, to reach the limit that you can, into retirement annuities or pension funds, so that you can get tax back on those contributions from the receiver of revenue.
Mm-hmm.
And it's a big drive. I don't want to say anything against the drive. I'm all for it. Um, I could just add that maybe that's just one tunnel, that you're looking at your retirement planning. This is just like one tunnel, which is good. You should go through it, but there's few other tunnels and few other like options that you have to take into consideration. Um, because of various reasons. So I don't know if you want me to go into that,
Yeah,
but
I think it's such an important point, because if you are looking at planning, one of the underlying principles is risk diversification, risk elimination as much as possible. If you're putting all of your eggs in South Africa, and the thing with retirement funding primarily is with an annuity, and I know things have changed since I was in the industry, but you're locking away a large portion of your money to have a compulsory purchase annuity, if I'm still correct on that, which means, then you're stuck here. If you want to take advantage of that tax savings, that's great. But what else is available if people say, okay, Zoran, I like what you're saying. How do I diversify? Show me what's available in some of the other tunnels.
yes, let me be honest and fair to South African retirement industry, and what's happening there is that yes, you probably get tax back money from your contributions, which will help you if, but only if, and this is very important, if you actually reinvest that money that you received from the receive of revenue. And why I'm saying this,
Sorry to
because
say
if you
that.
don't reinvest, then
That's a
more,
great point. So because that's the
yeah,
real value of that, right? Is you get the
yeah.
money back. It's for retirement. It's not for lifestyle or other things.
Well, unfortunately, my 24 years of experience, 90% of the client, well, I can actually say 95% of the client just say, okay, I'll pay less tax.
Mm,
So instead of paying like 150,000 tax because you put all your money into the RA, now your tax comes down to 80,000, maybe comes to zero, whatever. So they 95 or 99 maybe percent of the time they utilize that just to pay less tax, which means they
right.
already, that money is already gone, it's not reinvested. Okay. And the problem with that is that when they retire, they will actually pay tax on the income from that annuity. That's number one. So this deferred taxation hasn't really helped them unless they reinvested that money so they can have a little bit more money later to cover for the tax that they have to pay when they retire. Okay, so that's one problem. That's the biggest problem, I think. Secondly, when you mentioned it, you only allowed to choose between 2.5 and 17.5% annually withdrawals from annuity. So let's say the client says, okay, well, you know what, I'm gonna, my kids will take care of me in 10 years, but in these 10 years, I need to live out of 100,000 Rand a month. And we calculate that 100,000 Rand a month income is maybe 20% drawdown from the annuity. We can't do that by law. This is a second level of problems that I have with South African. There's three level of problems. First one I explained with the tax credits. Second one is restrictions, and this is the first restriction. So the restriction of drawdown. So you can only draw between 2.5 and 17.5%. And bear in mind, it used to be I think 22.5% before. So they actually kept on decreasing that. I have a lot of clients who retire overseas. They go for the kids, and then they still have something in South Africa, so they can't really fully emigrate financially, cancel all accounts or anything. Basically, they need to leave account for the annuity purpose. And they're very very angry now because they would like to draw more money because of the rand situation. They want
Hmm.
to have pounds as much as possible, but because they are limited to only drawing 17.5%, they will be drawing that for next 10, 15, maybe 20 years because the returns are quite good. So we're not really depleting the policy so quickly.
Right.
Um, and they are not, all of them are angry about that. As soon as they realize, they said to me, okay, if I immigrate and if I want to take the whole cash out, what is the situation? Well, then if you took a lump sum before, and most of them did, in like in 1/3, I mean, the situation is bad. You're looking at about 30 to 35% flat tax on your total amount. So then I said to the clients, it's not worth losing 35% because you never know if the rand, it's like saying rand devaluated today 35%.
Yes.
So it's not going to happen. So it's not going to happen. So it's still better to keep buying it and doing it on a monthly basis, because just to lose 35% of your capital, it's like crazy. So it's a big problem, and people should think about it. Especially if they maybe have idea to retire somewhere else, maybe, or live a little bit, live in South Africa and somewhere else like I am. I'm in Europe and I'll come back to South Africa. So you need to have that security. So that's one restriction. Then you have restrictions that are coming into the thing, that how much money you can invest offshore, how much money you can invest in equities. So that's another restrictions. So you can't structure the portfolio to the client according to his specific needs. You have to stick to those restrictions. We call it Regulation 28, but that's not the biggest one. What I heard now that the law will be changed even more, and they're gonna have some kind of compulsory. Maybe I'm saying this is in a draft. This was the papers, but percentage like 10 or 20% of your retirement planning will go into the government-owned entities.
Right. Sure.
Right. So if you don't like Eskom or South African Airways because they're losing money, tough luck. So these are the things that scare me, and scare me a lot, and that's why I'm saying to the people, all right, so we have these two reasons: transfer of the tax liability late on, which is actually bad because you don't want to be taxed when you need it the most, when you retire, and now you're happy because you're getting taxed back, and unless you really discipline, it's not going to work well for you. You have all these restrictions are spoke about, and then lastly, very 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 simple, you named it. It's called diversification.
Mm-hmm.
So you want to have something that is not in South Africa. You want to have something that's growing in a hard currency, and you want to have something that when you retire, you can get portion of the money from that investment or that policy from overseas, no matter what the circumstances are in South Africa. So what you're doing, what are you actually, how are you helping yourself in two ways? First, I just mentioned, you're not you're not reliant on any kind of rating, agency ratings, or economy of South Africa, of South African companies, insurance companies. If that's all bad, it doesn't really matter because you still have a hard currency annuity that's coming to you from overseas, okay, from the offshore investments. So that's one aspect that you're taking care of, which is a big one. And the second one, and probably the most important one, because we love South Africa and we think that it's going to stay strong still. But if you look at the chart between US dollar and rand in the last 30 years or whatever, you will see just one-way street. It can go a little bit like this, but on a longer term, it's just going down and down and down. So there, if you have offshore investment that gives you monthly income in US dollars or pounds, you then catering for the inflation problems, because when you retire, if you have only South African portfolio and inflation is high, you can't really draw much more money
Mm-hmm.
to cater for the inflation. But if the rand is weak against the US dollar, then already you will receive more rands for the same amount of US dollars that you had before. So it's a
So
perfect way of
just for the
actually,
currency hedge, you're able to
yeah,
increase
currency
it.
hedge.
And then
Currency hedge, inflation hedge.
a currency hedge and inflation hedge. And you can also then elect in a year for your drawdown rate. Is that an option where there's a variable drawdown rate? So if the currency decreases, you don't need the rand decreases, you don't need the money. You can leave more of the funds in your investment to grow and take out less because you're bringing in more because of the depreciation of the rand.
Yeah, well, that's a whole universe now that you that you just stepped into the offshore, basically the millions of products.
Right.
But 99% of them are as such that you can use any amount of money
That's
as and when you want.
Have you had
So
clients reaching out to you? Sorry to interrupt. Have you had clients reaching out to you now with the look of what's going to be happening with this potential of appropriation without compensation? So it's currently and the appropriation of property, physical property. But that could change very easily to be pension funds, any of the fixed investments here. Have you had any of your clients reaching out to you expressing concern around this potential new bill that's coming through?
no, not yet, to be honest. But the reason for that, I think, is that the clients are mostly politically now interested in what's going on, and they're like looking at this particular law, how it's going to affect the South African economy and everything else. And they're not thinking yet, obviously, about possibility of that rolling over to the investment schemes. Um, and I must say, I don't see any signs of that happening. Um, so honestly, I don't see any signs of this happening. Having said that, I don't have a crystal ball either. So I don't know what can happen in a year or two. Who might take the power? What kind of ideas they can have in their head to change the laws?
Mm-mm.
This is again. You see, so this is probably for number four reason for the offshore diversification. So in a country that is new, I mean, our democracy is quite new. I mean, we've been living under apartheid for a long time. So in those kind of countries with a new democracy with a short span of years, you will have tribulations like this going on quite often. So having a knowledge of that, we should, as much as we like and as much as we have a trust for the right reason in South Africa financial sector, which is actually very robust and very good, we mustn't forget that the foreigners are actually the biggest investors in our bonds and equities purchases. So,
Mm.
very quickly the rand and inflation can go up if the foreigners start pulling the money out of the South Africa, and that is connected to some of those laws that we're mentioning that can happen or might happen, and the one that is actually happening right now.
Well, and
So
the
the prudent,
US pulled. I mean, the US has pulled the plug with aid. They just said pens. That's their pens down procedure where everything stops and gets reevaluated.
Mhm. Yeah,
So not only is your future in this country potentially affected by the decisions the government makes, it's affected
Mhm.
by the decisions other governments make, other countries' governments make that
Yes,
can have on the safety of your savings in your retirement. And this is really one of
yes.
the reasons why we've started this series is everything
Mm.
that we do on this podcast is about really living your best life, becoming optimal, becoming the best version of yourself, but also self defense. So on the weekend, I was fortunate enough to teach a self defense workshop to a bunch of young adults who were from challenged backgrounds. They had some pretty tough stories to tell. And that self defense is physical self defense. But if you're not looking after yourself, particularly in old age, where you may not be cognitively as capable of looking after yourself or have the physical ability to generate more income, you don't want to be stuck in a position where you're at the whim of your government, you're at the whim of other governments, and your income is dependent on that, which in reality is no security. I mean, you and I both know that so many people believed 20 years ago, because it was our parents' generation, that you left school, you went to university, you got a degree, you got a job with a company, and you stuck with that company for your life, and the company looked after you from basically starting through to retirement. Now there's no security really in employment. The world's in chaos. You need to do as much as you can to protect yourself.
You actually um, something came to my mind while you were talking.
I saw that.
And this is a thing that we need to share with the clients.
Mm.
It's not just retirement planning, it's not just the currency, it's not just the fancy words and the laws and everything we spoke about. The fact is, the world is changing at a rapid pace by the day,
Yeah.
not by the month or by the year, by the day. And that on its own is a big enough reason for us to question all our past beliefs.
Decisions. Yeah, right.
All our past beliefs in what's right, what's wrong, where to invest, how to invest, everything. So, I mean, while you were speaking, I was just thinking about a client of mine who's got 100, I think, 189 properties in South Africa. And you see, that's that belief, okay, I'm going to have a tenant and I'm going to have everything. But now, just let's drop back a few minutes and just see what we are talking about. I mean, if we are not certain that other governments can affect us, which we are not, and we're not certain what our government can do with the laws, which we are not, why would we put all our eggs in one basket? And this is the best basket for the high net worth individuals, to be honest with you. This is a property. And somehow still think that we're living in 2010 or maybe 2001 or maybe
Yeah.
1990s, because 2025 you saw what happened with all the laws that happened in the first 2 weeks of Trump's
Yeah. Presidency.
power.
Absolutely. Yeah.
I,
100%.
I, I mean, if it carries on like that, then Europe is also in trouble to a certain extent. Um, and now we kind of touching on the geopolitics and what's happening, but it's very much connected to what we are talking about. And what we are talking about is sit down, scratch your head, and say, okay, everything I knew about what I should do from my financial advisors, from my companies that are advertising online, You know, your liberties, your momentums, your everything, everything I taught myself over the YouTube for the last 20, 30 years might not be enough to actually save me next 5 to 10 years, never mind in your retirement, but specifically in your retirement. Because if we're talking about people who are 50 years old now, they should actually act right now if they have some money, because in 5 years they might be in retirement, or in 10
Mm.
years. So you can't wait until you're too old to do that, because it might be too late.
Yeah, absolutely.
I mean, if you're
And
65, it might be too late. So
I think,
if you wait until you're
yeah.
65, if you're 65 now and you can do something about it, by all means, contact somebody. I don't know, like myself, because
Just
I
get in
know
touch.
that I've
Just
been
get in
through all
touch with
this.
Zoki. Yeah,
Yeah,
hundred
yeah, yeah,
percent.
true.
You
That's
know
actually true, because
that's why you're here. And I mean, just you have a great local knowledge. You have a great international knowledge, and you've been stuck
yeah.
with me for 24 years. He's patient, guys.
Yes,
Just
yes,
something else
yes.
to consider when you're
Well,
talking about a client. So, I'm just going to jump in
yeah,
here. You're talking about a client with 180 plus properties or 140 plus
yeah,
properties. It's not even about protecting what's now based on what could happen in our lifetime. You need to protect the generational wealth that you worked for, because you don't want all of that work and all of that wealth creation to be wiped out and for nothing for your heirs, for your generation. You want to be able to leave them with an option, right? With a safety stick, with a yardstick for a better quality life. I don't think there's any parent or grandparent in this world that wouldn't want, or great grandparent that wouldn't want their kids, their grandkids, their great grandkids to be able to study anywhere, to be able to live anywhere, to have a safety net that if things go wrong, they're protected. If they marry a spouse that's not best for them in the long run, that those assets are still protected. So all of these things need to be taken into account, particularly when you spent your lifetime. You spoke about people in their 50s. You spent your lifetime working to create wealth, and now it's tied up and it's at the mercy of the state, at of the mercy of foreign states. All of these things become very, very problematic. So we don't want to
you
scare
know,
people.
yeah, no, no, but I mean, last time we spoke, I think me and you spoke about our lives, and you mentioned to me that you are actually not. I'm not financial advisor. I'm the person who makes other people stop making mistakes.
Correct.
And I think right now it's very important time to have somebody like that. Because if I tell you, when I speak to my clients,
Right.
off the bat, high network individuals, some of them have this kind of opinion about having a property portfolio or big companies. They say, look, you know, it's very valuable, so I don't need to diversify, and I don't need money for the life cover, for estate duty, or for capital gain tax, because it's so many properties. It's easy for them. They just to sell one or two. It's still going to be enough for them. That's particular point that you mentioned. That they want to leave things to the kids, and these people are not the ones who says we don't care about kids. They do.
Yeah.
Somehow in their mind, they're looking at the value which is right now and which could be sold in like 3 or 4 months. Very good show housing, or whatever, negotiating on a business property. The problem is, if they pass away, the executor is selling the property, and people who are buying off the executors are buying below, big
Yeah.
time below price. And the state duty is payable in 45 days. So what can happen is that the children can come to the situation that they need to liquidate maybe 5 or 6 or 10 or 20 properties just to be able to pay the state duty. And when I say liquidate, I mean selling them far below the value. So
Yeah.
what have you done? You actually lost money more than paying for the life cover, because if you let's say you bought those properties for 20 million rand, and now they're worth 35 million rand, and you say,
Right.
listen, I made a good deal, my property is now 35 million and I spent 20 million. But once you pass away, your kids have to liquidate them for 10 million. That basically means that you actually lost them 10 million rand, because you had
Yep.
20 million before. And
And
these are the things that people are like very casually going about.
And I think you've touched on such a great point where you stop people making mistakes because of the experience you bring to the relationship. But it's also that
Yes.
the decisions that you made, and we spoke about this at the very beginning, you need to have a review. You need to sit down with a professional and review what you have and what you've done because things are changing on a daily basis. So the decisions you could have made 6 months ago, 5 years ago, 10 years ago, we were 100% correct at that moment in time. But right now, they're mistakes because they don't serve you. So, a good decision, a correct decision, can very easily and very simply become a mistake because the world has changed and the effects of that decision may no longer serve you as much as you need, as effectively as you need. So, you have to review, and that's really why we wanted to do this talk today. And we're just touching we're just touching on retirement funding. We haven't even touched
It's
sort of on other investment and risk and so on. So those
Yeah, we were
really are
talking about
key.
risk as far as the stage critical and stuff like
Yeah.
that. And but I was thinking about what you were saying now. Um, that things are changing so fast, and you need to always review.
Mm.
As a matter of fact, after 24 years in the industry, I changed my retirement policy to the better offshore plan January this year, 2025. So I found something better, and I thought I knew all the great investment stuff before, and I knew where my money is, and I knew that's the best thing. But I found something better in 2025. It just tells you, usually before, if you're broke and you come to my age, you just have the pension fund or something, and you say, okay, I know exactly how I'm going to retire, and this is perfect. But things are changing so much that I actually did it for myself too. So yeah, you're absolutely right.
And unless you're a old Liberty defined benefit pension fund member who's retiring at 55 years of service, so you're getting 110% of your final salary, and you're smiling
That's
because
great.
you're getting an increase to retire. That's
Yeah.
also, you're okay. Not to say that anything's going to happen to Liberty, but again, also your benefits are locked into the company's liquidity, and that becomes a long-term challenge within itself. But so what else? So we've got the risk, we've got the investment side, we've got the retirement side. On the investment side or the risk side, in terms of life cover, what should people be looking at, particularly to say, okay, if I die here, okay, I've got a South African based will, but if I want money to go somewhere specific and not come into South Africa, that's just sitting there as a nest egg, a parachute, or a large income for my dependents, what's available to people? What should they be looking at now at this time of the year? We're reviewing, and it's time to look.
Okay, so first what I have to say is for this to make any sense to the clients and our listeners, we will probably have to have a webinar or just one podcast exclusively done to this. And I'm not saying this because I would like to talk about these products from A to Z. I'm saying this because the products we have now and I have actually right now in contact are totally, totally different from the products that we have in South Africa.
Mhm.
So if I start telling you quickly about some of the features, I actually had it today with some of the directors of the big insurance companies. I start telling them everything, and on the end of the conversation, he says, "But you throw money, but you throw your money away on that policy." I'm like, "We spend 1 hour. You're not throwing money. The money actually stays." So it's very difficult to explain. But let's just say that quickest thing will be to book a
Consult.
free of charge
Mm.
consultation with me, so I can actually first see exactly is there any way I can help clients right now, and then I will actually on one go through what are the best solutions. But let's say what we do have is we have high value life covers, which is the life covers from $1 million up, um, and the term for those life covers are flexible, which
Mhm.
means you can pay it lump sum. So
Right.
you might say to me, you know what, I'm leveraging my portfolio, I'm borrowing from the bank, and so I'm just going to pay the interest. Give me a lump sum quote. So I said to you, okay, Nick, for your age, you want $10 million, it's going to cost you $196,000.
Mm, mm.
There is a lump sum payment for the life cover, okay? Then you have a term, you can have like a 5 years, 10 years, 15 years, whatever your affordability um, allows you. However, is it a lump sum of 5 years or 10 years, 15 years? Doesn't really matter. That money that you invest for your life cover stays in your investment pot invested for you to utilize in your retirement.
Right.
Okay. So you're not throwing money away. You're actually doing two things. You're putting some money into the retirement pot and you're paying for a life cover. And this is something that's very hard to be understood if you're South African. If you paid once off for a life cover,
Mm-hmm.
you don't have to pay a cent anymore. You're covered until the end of your life for $10 million.
Yes.
So if you want a policy for estate duty and you don't want to think about it, premiums in 10 or 15 years down the line and what your situation will be, then you look at your affordability. If you can pay lump sum, great. If you can pay in 5-year installments, great, or 10-year installments. So you basically pay like $10,000 or $20,000 a year. You pay it in 5 years. After 5 years, you don't pay anymore. You're covered until the end of your life. So there will be a payout to your estate or to your children. No question asked. And this 5 years that you've been investing money in, after year number 5, is already accessible to you to actually draw for your retirement.
Right. Sure.
So these are your premiums that have grown in investment. So you have a risk that is guaranteed until the end of your life, and you have a premiums that have grown that you
Cash
paid
flows.
for the life cover.
So,
Okay, so we don't have something like that at all. Universal Lives was close to that, but cash wise was not even close. And obviously, if you stop paying it, then you have a penalties, then you lose your life cover.
right,
So here,
exactly.
when you finish paying, you don't lose your life cover. This is a big mindset change. That you're actually just planning to have the life cover until the end of your life, and you say, okay, I want to do it in 3-year term, in three terms, or 5 terms, or
Right.
10 years, or lump sum.
So I think,
That's one thing.
okay, so and I just want to jump in
Yep.
on this with you. Something that has always frustrated me where people, because I mean, in the 15 years I spent in the industry, I went 7 years before I had a death claim. And I had a death claim with a client quite early on where they'd not really paid a fortune in premium, but they got a massive lump sum and they lost their dad, but they got a massive lump sum. You will never find somebody who is claimed from a risk policy, life insurance, capital disability, income disability, or dread disease that feels any of their premiums were a waste of money. You're insuring your car, you insure your house, but yet we have this issue of insuring ourselves is a waste of money, where it's really not. And so that's my bugbear. I just wanted to I
So
just
here
wanted
it
to put
is.
that
So
across.
you see, did you understand how this policy works? You're
Yeah.
not throwing money away.
You're
You
not throwing money.
actually,
Yeah, that's it.
your premiums for the life cover are invested for you to use after 5 years. You can use everything and just leave $100 in a life policy.
Yeah,
Okay, and you still have your whatever the life cover is, $1 million or whatever. You still have that until the end of your life. Somebody will get it. Somebody will pay estate duty. So
absolutely
you
phenomenal.
actually have both things here.
Yeah. So Zaki, and I need to run to the bathroom very quickly. So for our listeners,
So I think,
because this is
okay,
live, I'm running to the bathroom. Um,
yeah.
Let me just express to you why, because this is what I drink on a on a daily basis. So just give our
Maybe.
listeners a quick understanding of that point that we've made now. I'll be back in 1 minute.
Okay. All right.
Fire
Okay.
away. Say what you got to say.
Okay, guys, whoever it is. Okay.
No, so
So
what I want to
basically,
chat about, we're chatting about the risk and the investment
yeah,
element.
yeah, yeah.
Why is it so hard for South Africans to understand?
Here we are. We spoke about, I told you in 5 minutes how the product works. And Nick just said, I don't like throwing money on a risk cover. So he didn't understand that this is not throwing the money. This is actually investment plus the life cover. Okay. Um, and this is the point. If you can have your money back from the premiums, why wouldn't you want to have guaranteed payout on your life cover. Or there are policies that you can attach to dreaded disease, okay, and they are cheaper than the high value life cover. So basically, they work the same in the same principle. You can pay 6 years or 12 years your premiums. This is just a premium term. So if you pay 12 years, after 12 years, all your money that you paid is guaranteed to be in your cash account value, which means you can use it. So you're paying 12 years for your dreaded disease cover and life cover, and after 12 years, you can get all of that money and invest or live for the retirement, use it for retirement. However, you are covered until the end of your life for dreaded disease and for life cover. And here's the thing that I was talking to Nick in his back. Welcome back, Nick.
Thank you.
Is
Straight
I
back from the
cannot see a
bathroom.
reason. I cannot see a reason for a person not to have the policy, for example, for the dreaded disease, if he can afford to pay the certain amount of premiums and then finish it off, and then know that he will have the dreaded disease cover until the end of his life,
Oh,
because A, the premiums are not wasted; they're coming back to him for the retirement anyway, and B, chances are 90% of the chances that you have a dreaded disease before you die. Doesn't matter how old you are, so you will have a claim from that policy. And all you did is 6 years or 12 years of premiums, which are coming back to you anyway.
right.
Sounds too good to be. That is after 2 hours of my client, one of my clients told me, why didn't I hear about this before? I'm like, well, you didn't because it wasn't available, and in South Africa it's not available. It is available through me, obviously. I think there might be one or two companies, small companies that are actually utilizing the services, biggest life insurance companies that are actually catering for this
Cool.
kind of products.
Zaki,
So
Zox,
maybe
your
next
signals just to
podcast,
can you hear your signal is breaking up, your image is stalling. Could you just check your internet connectivity?
yeah, I can see.
Okay, all right. So we're just losing you a little bit,
Yeah.
but I think that's a great place to wrap up. I know we committed to try and keep these under 45 minutes. We've gone over, and we've had a little bit of extra time, but I think we've covered a lot on
So
this
maybe for
episode, and
next
we'll
time
go
we will
into
go.
detail.
Yeah,
Yeah, we'll go into detail on each of these ideas because you mentioned
exactly.
your new product and
Best.
you swapping things out, and I'd like to chat to you. I want to chat to you about that. Why you changed? What made you change? What was your thought process that you were going through in
Mm.
making those changes? Because I think that's exactly what clients will be experiencing and thinking. So just as we wrap up the episode for today, what we I think the biggest advice, the biggest takeaway I got is that it's definitely time for a review. Even if you looked at it 3 months ago or 6 months ago, have a look at it and have a look at it from an international aspect. Understand that you may not know everything. The team that you're working with may only have access to information that's in South Africa. So just get an opinion international. I know, we're not doing this to promote you, but I've known you for a long time. So reach out to Zoran, get in touch with Zaki, and just let him have a look at what you've got. I mean, there's no cost, there's no obligation. He's the sweetest guy in the world, and just get an
Yeah.
understanding of where you stand. That's sort of what I would like to wrap up with. How do people get hold of you?
They can get hold of me on LinkedIn profile or on my website, zoransokolovsky.com,
Right.
or they can
And
email me.
yep.
The simple email, well, this is zoran at zoransokolovsky.com.
.com.
And then
Right.
there's an easier one, sokozoran at gmail.com.
.com. Perfect. And I think
Sokozoran
that
is just like a short.
I think LinkedIn is a great way to get in touch as well. So you can look up Zoran,
Yes.
Zoran. Sokolovsky is Sokolovski, and I got that right. Not bad, hey? So,
Yep.
Zox, I don't know
Not
what's
bad, not bad.
thank you with the connection between us, but thank you for your
Yeah,
time.
the
Thank you for making yourself
connection is
available for
breaking.
this.
So
Yeah, So I'm not sure how we are to you.
Thank you.
We've
Thank you
got good
very much.
bandwidth here, but thank you so much for your time, Zaki. It's been great chatting to you, and I'm going to end the conversation now and talk to you off air. And we're looking forward to chatting with you next week.